you'll hear folks who are, I guess, looking at things half full. And they'll say, look, semiconductors have outperformed. They look pretty good. Coming into this phase, you did have some cyclical sectors that really were distinguishing themselves. It seemed to be sending a relatively reassuring economic message. Whether we can believe it or not, it seemed to be what the tape is doing. Now, banks falling apart, probably never good in any of these scenarios. But I wonder how you just sort of read the leadership profile.
Yeah, so certainly coming into the year as a strategy team that was negative coming in, thinking 4,100 was a ceiling. When you hear stories about China reopening, not only semiconductors, but basic materials, industrials, all the deep cyclicals really getting an enormous bid into January, that's something that concerned me. And if that persisted and made the case for a PMI cycle bottom, we would have had a problem with our view. But as soon as you got into early February, even before that, the whole China-centric story started to fade. And more recently, with the panicky type trading that we've had in recent days, cyclicals really came under extreme pressure. Things like copper-gold ratio, European autos. I mean, you can go down the list with one exception, semiconductors, that not only held their bid, they actually caught an additional bid and almost started to act like secular growth. And we kind of wrote in a note that we published yesterday that semiconductors have a bit of identity crisis here, where there is some rationalizing. These are no longer cyclical plays for various reasons and narratives. These are secular growth stories. And, number one, that story is very stretched on the same modeling that makes the NASDAQ look somewhat overbought now and certainly limited upside. Semiconductors on that modeling using things like Fed expectations, economic surprise data, semis are incredibly stretched now. And we'd argue that this 3,200 area on the SOX is probably something of a ceiling for the semiconductor index.
I wonder if that's really just a read on NVIDIA being so much bigger and more of a force in the index, in the semiconductor index, and it itself is surrounded by secular growth sentiment. I mean, it just seems like that might be that kind of a profile. It's the market care dominator in that sector. Now, to be clear, you're thinking that we have to go back toward or to the October lows in the S&P. Eventually, this is going to work down that way?
That's correct, yeah. And basically, the idea is we get a retest of the lows. And when you go back historically and look at recession-driven bear markets, that's still something of a more muted bear market when you associate the ones with recessions, if we're just simply retesting 3,500. And what would really, bolster that view, and what we've been watching most closely is across the market when we look at the fixed income market. If we see a continuation of the the bull steepening that we've seen in recent days as the cyclicals came under pressure, if that is reinforced as equities start to sell off toward that 3,500, ironically, it's the bad that will make the good. It's a market that looks forward and sees the Fed will pivot as we get into the second half. And then we'll look for things like cyclicals to actually start to outperform the deep cyclicals that you normally look for. Small caps outperform. But for right now, the point is we still have to get through the down before we can get to the up. And people should be really focused on risk management at this point, especially where markets are priced today.
Got it. And just to be clear for folks, a bull steepener in the Treasury curve is short-term yields go down more than longer-term yields, which is exactly what's been going on as people have positioned for potential Fed rate cuts in the months ahead.